Sometimes a stock share price diverges from its fundamentals. In this episode, I analyse such a company. Imagine picking up £1 worth of clean energy for the price of 70p and being paid a 9% dividend yield along the way whilst being fully backed by free cash flows. That's exactly what's on offer with Octopus Renewables Energy Investment Trust plc. It's profitable, it's income rich, and in today's market, this mix of high yield and deep value is almost impossible to find. In this video, I'll walk you through my investment thesis and explain why ORIT could be one of the smartest additions to your portfolio right now. Welcome to my channel, Adrian here. I'm a chartered financial analyst and a chartered accountant. Just stock deep dives, real analysis, no hype. Let's create a dividend-paying portfolio with high upside, low downside. So the company, as mentioned, is Octopus Renewables Infrastructure plc. Recommendation is strong buy. The reason to buy is the company has strong fundamentals, has a reasonably low price to book. It's got an ESG policy, of course, because it's a renewables energy company. Has a high dividend yield. It's currently doing a buyback program, and it's likely to have fair value gains as interest rates fall, as I will explain. Reason not to buy is that the company has had some fair value losses over the recent couple of years due to higher discount rates and weak power pricing, both of which are really largely out of the company's control. And also, I feel that there's limited analysis that can be done on this company, given that it is an investment entity, which is a bit of a complicated accounting thing to think about, but in a nutshell, it's just a bit complicated from an accounting perspective to be able to analyze it. It's not very transparent. But I've done quite a lot of the work here, so this is what I'm talking about. Octopus Energy is really well known in the UK. It has a big brand over here. I've just moved into my new place and I've just received these through the post to subscribe to them as my energy provider. In fact, Octopus Energy has become one of the largest domestic household energy suppliers in the UK, serving around 24% of the market as at January this year, and it surpassed even British Gas on that. So the company has a net asset value of £540 million and a progressive dividend policy. It has a reasonably low price to book ratio of about 0.7. As that very recent. The company has seen its share price decline over the past few years from around 110p per share in 2021 down to about 70p per share as at 13th of August. This decline is largely attributable, from my analysis, to negative sentiment in renewables in general, and that the company has experienced some fair value losses, as mentioned earlier. Despite this, the company has delivered consistent profits since 2021, generating cash flows that have exceeded its annually increasing dividend by approximately 11%. In addition, the company has a revolving credit facility of £97 million. It's quite cash rich. It's very well managed. The dividend policy is targeting inflation with a 2.5% year-on-year increase in 2025. At this lower price, the dividend yield today is around 9%. If the past 2 years are repeated in the future, the dividend yield at today's price will keep increasing, and I can see it, if you buy it today, potentially having a dividend that's paying over 15% in the coming years, because I do see this progressive dividend moving forward, increasing, and especially with declining interest rates, this company, I believe, will start turning fair value profits. This was stated in their annual report, where they said that a 0.5% reduction in discount rate, which you could, say that interest rates would be a large portion of that, will have a 5% impact on their net asset value, which is huge. It's huge, and we're seeing the Bank of England reducing interest rates this week, and this will start to come through in their accounts. They are diversified around Europe as well, so it's not just the UK, it's also the ECB rates that need to be looked at, but the reducing interest rates is quite a sentiment around Europe right now. The assets also have a very long life of between 30 to 40 years, and this really does hone in on the fact that the company should have cash flows into the future. So I don't see any reason to think that the company will stop producing positive cash flows. The company also has a buyback program, which should also reduce the discount. This is their share price, as mentioned. So 2021 was around 110, even higher than that, as you can see in this chart. Recently there has been a bit of a decline and then an increase. So it's kind of moving. I can't say where the share price will be next week, in a month's time, 2 months, but what I can say is that over the long term, I definitely see this company improving. You can see here in the key figures that the market cap has reduced alongside the share price. The NAV is pretty stable was 578, now it's 540. So imagine that. So back in 2021, the company had a market cap of 625 million and a NAV of 578, which meant that the price to book was 1.08. Now, as you can see, the net asset value has only gone down by about 30 million to 540, and the market cap has gone down by, almost 300 million. So this really just shows you that there's a big discount over here on this company. The real surprising thing is that the free cash flow has actually gone up from 20 million back in 2021. It's doubled to over 40 million. It's like 43 million in 2024. That's vital. And also, it's been profitable ever since. So I really don't understand the discount from that perspective. So I definitely think that there's a big buying opportunity over here. So my concluding investment thesis is that the company has a relatively sizable balance sheet. It's been profitable over the past 4 years. It has positive free cash flows. It's increased by 43% since 2022, or even by 100% since 2021, as shown in the previous slide. The company has a very low price to book of around 0.7. From my analysis, the average price to book that I've seen in the energy sector on the London Stock Exchange for the main market listed companies is around 1.13, highlighting this real undervaluation compared to peers. The dividend yield is 9%, which is huge for a company with this profile. Other things to mention are that the long-term assets have a useful life of around 40 years. The debt to equity is reasonably low at 27%, and renewables in general is a growing sector. This is an ESG clean company. I believe it can grow with AI, as whenever you look at AI, there's always commentary around needing renewable energy to fuel AI and the whole AI growth. So I think this is a very well-suited company to do that. And of course, it's a very well-known brand name. So if it came that Octopus Energy went bankrupt, I would be quite surprised. So that's my analysis. I recommend a strong buy. Thanks so much for watching. If you found this helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss any future videos. Drop a comment below if you have any questions or topics you want me to cover next. See you in the next one.